Just bounced. Irish goodbye. Oh, that's a. I almost need to rewatch it to see how many times he contradicted himself or intentionally misled on the currently available data, because there was a few of those too. I don't think anyone bought into it based on the price action of the last couple hours. Obviously, we've drifted down here. The earlier de-risk of 44.35 that we saw before the meeting has kept volatility from moving up too much, but should we slide further below 44.25, that could begin to walk up even more. I think if there's an attempt to rescue the 44.50 strikes, or what's left of them, we'll probably see that sometime here into the end of the day, maybe on the back of some zero DTE put capitulation. I feel like he was pretty clear that the soft landing is, I mean, the soft landing has always been like a goal, but not, a guarantee, right? And I think in his initial statement he was trying to reinforce that it's not like the Fed's guaranteeing a soft landing. It's something that they hope to achieve. And I think he got a little tripped up and he got tricked by the next question a bit. But yeah, I mean, nothing coming out of this is bullish. So what we're looking at ultimately is we're looking at a federal funds rate moving up to 5.6% by the end of this year. That means another 2.5 hike, basically, and a range of 5.5 to 5.75 is how it will be presented. But with the effective rate at 5.6, and then this is where the bull case kind of falls apart. Previous to this dot plot, there was a projection that the Fed rate would then go down, starting from the beginning of 2024 into 2025. There was an expectation to cut rates aggressively. This case was the final supporting piece of evidence for any bull case and continued earnings yield into 2024. This is gone. The Fed now expects to cut rates, but nominally in 2024, and really no clarification on what part of 2024, but probably, into mid 2024, their June projection. But they plan to maintain a rate above 5% or 5.1% into 2025, which means no 4% rates next year, no 3.6% rates by the end of next year. All of this needs to be repriced in Fed fund futures. This needs to be repriced in the bond market. And more importantly than anything, this needs to be repriced in the equity market. That effect over time is not conducive to short or midterm growth. Now, the Fed is largely trying to ignore the effective energy. They're not, I mean, he was very obviously trying not to address it, even going so far as to ignore the already visible knock-on effects on core inflation. But I will say this separate from his statements. Energy's effect cannot be removed from core. So higher energy prices for a sustained period of time will be realized on the producer side, which they already are at a very, very rapid rate. And they will be bled over into core services and goods and durables, especially. And that lagging effect of energy into durables, I think it's already being realized. We've had higher energy prices pretty consistently for almost 3 months now. Next print is going to be even higher. And so the Fed is avoiding, they've got 2 hot prints. They're avoiding discussing that effect because they don't have 3 primarily. I mean, they don't have, generally, they haven't in the past spoken on data points that don't occur in triplicate. And that's kind of the 3-month quarterly trend that they're looking for, because obviously, the hope would be that energy prices fall and then we get one more hot print and then they start to cool, which is clearly what the Fed projection is assuming currently. I don't think that's true. I think the strategic oil reserves are down. U.S. ability to control oil market pricing is not very strong right now. I think Saudi Arabia and Russia and possibly other large oil producers will hop on board in extending these production cuts. Because the U.S. has so little influence over the price of oil, they can really get the median price per barrel where they want it, and for what's best for their economies that are driven, where their growth is driven by the price of oil primarily. So a little bit of advantage to them. Also, any shift in China's current economic outlook, any planned government stimulus by China would be bad for China in the sense that they will compound their already egregious debt. But at the same time, they need to do something to stimulate their economy. Otherwise, it's kind of in a free fall scenario. So the expectation should be that China will take steps to protect their economy and to try to stimulate it in some way or another. And if they do, that is going to create a even stronger demand on what is already a fairly weak oil supply. And I could see, I mean, at that point, like right now, I think oil can roughly sit where it is, between where it is and 100 a barrel. If that Chinese demand comes in, we're talking oil to 110, maybe 120 a barrel. And then, obviously the inflation effect, the bleed over effect into core, not only is all of that going to last a lot longer, but it could be significantly greater. Someone asked earlier, why not raise 100 BPS right now? And that also has to do with inflation, and it has to do with the destruction of money supply broadly, that the Fed needs to continue doing effectively. And if the demand for bonds, long-term bonds especially, is low, and the Treasury is issuing securities at a steady pace, then the Treasury's issuance becomes additive to broad money supply, right? And then raising rates inherently will make the Treasury have to pay more to service that debt, driving more inflation. So JPOW needs to keep rates fairly contained while decreasing economic projections in order to increase demand on those longer term yields, right? And the best way to do that is really nominal rate increases and pauses, right? Like keep applying the pressure, but keep the rate steady and push that, extend that window of time that will exist out further, right? Which they've done at this meeting. They've extended a strong federal funds rate into the end of 2024, right? And by creating that demand on the long-term yields, Treasury issuances no longer have that additive effect to inflation and money supply because he hasn't really jacked up the lot. He's just increasing the demand, right? So he needs to get people to eat the shit sandwich and take the treasuries at face value and stop trying to get, milk them for more. Like a lot of banks don't want to go long on the yields because they want yields at, 7, 8, 10%. He's not going to let them have that because that will drive more money. Like reaching that target for the banks will drive, the bank's risk back into the treasury, and the treasury will have to expand money supply. So he wants the banks to take the losses, not the treasury, not the Fed. And it is correct, right? And a large part of the reason that interest rate increases don't really do anything besides that is because our current inflation environment is not driven by over-lending practices. Our current inflation is driven by supply demand, and then excess demand and wage inflation due to excess demand and supply side inflation and profit inflation, right? So we'll see. We'll see if it works, if the banks are gonna fold. They should because he's just told them they have no rate decreases in sight, no chance to to buy the top on the yields anytime soon, and debt servicing is going to come in hard into the beginning of first half of 2024, and that debt looks like it's going to be serviced at a rate of 5% or higher. And as far as future growth goes, that's bad. That's that's a big headwind. What debt needs servicing? It's about 30% of the S&P 500s, or there's 40 something percent of the S&P 500's rotating credit supply needs to be serviced within the next 2 years. Or wait, are you guys talking about the Treasury, or rolled over, or are you talking about the Treasury debt servicing? The Treasury has to service the national debt. So when they issue securities, they have to pay the interest on those securities. If JPOW raises rates, the price of the yield on those securities goes up, which costs the Treasury more money. And if you're talking about the restructuring of corporate debt, yeah, it's like 40 something percent over the next 2 years. It's far more than that broadly, but I only know the statistic for the S&P, and even that's loose. I'm not really sure on the exact percentage. It's somewhere between like 38 and 43. What I don't understand is how market forces won't take effect and fix the issues over time. We can't trust them to do that. I agree that we should have a crash and we should force a recession, and that's the fastest way to the goal that the Fed is trying to achieve. It's just the most painful one. Just let everyone my age in the office know that Fed funds rate won't moderate until 2027, meaning in California, housing prices will be affordable until 2030. We all just opened a group OnlyFans. To summarize, SPX 4600 by noon tomorrow, I think the bulls are dead. I mean, we're almost at delta neutral right now. They barely were able to get a bounce back. There was almost no capitulation in the put side on the first drop. Clip this, but like everything since the meeting, like my whole big rant.